Hey everyone, and welcome back to the channel. Today, we're diving deep into two powerful trading strategies that can seriously level up your game: breakouts and fades. Whether you're a seasoned trader or just starting out, understanding how to use these techniques can help you spot incredible opportunities and manage your risk more effectively. So, grab a notepad, because we're about to break down exactly what these strategies are, how they work, and how you can use them to potentially maximize your returns. First up, let's talk about the breakout strategy. Imagine a stock price that's been bouncing between two levels for a while, like a ball trapped in a box. The top level is the resistance, and the bottom is the support. A breakout happens when the price finally punches through one of these levels with conviction. Why is this so significant? Because it signals a potential shift in market sentiment and the start of a new, strong trend. Think of it like this: when a price breaks above resistance, it's like a crowd of buyers suddenly overpowering the sellers. This surge in demand can push the price much higher. Conversely, a break below support indicates that sellers are taking control, which could lead to a significant drop. The key to a successful breakout strategy is to identify these key support and resistance levels and then wait for a decisive move. You're essentially riding the wave of momentum as it begins. So, how do you trade a breakout? The classic approach is to place a buy order just above the resistance level or a sell order just below the support level. Volume is your best friend here. A true breakout is almost always accompanied by a big spike in trading volume. This high volume confirms that there's real strength behind the move, not just a random price fluctuation. Without that volume confirmation, you might be stepping into a false breakout or a fakeout where the price quickly reverses, and that's a trap we all want to avoid. Now, let's flip the script and talk about the complete opposite, the fading strategy. If breakout trading is about following the crowd, fading about betting against it. A fade trader looks for moments when a price has moved too far, too fast, and is likely to pull back. They believe the move is overextended and due for a correction. So, if a stock shoots up rapidly without strong fundamental reasons, a fade trader might short sell it, betting that the price will drop back down. Fading is essentially a counter-trend strategy. You're standing in front of a speeding train, hoping it will stop and reverse. As you can imagine, this can be riskier than breakout trading, but the rewards can be quick and substantial if you get it right. The psychology behind fading is that markets often overreact. Excitement or panic can push prices to unsustainable levels. Fade traders are the calm voices in the room, capitalizing on these emotional extremes by betting on a return to a more rational price level. When would you use a fading strategy? It's often most effective in range-bound or choppy markets where clear trends are absent. You look for sharp price spikes or drops, especially on low volume, as these are often signs of exhaustion. For example, if a stock jumps up to a major resistance level but the volume is weak, it's a classic signal that the buying pressure is drying up. A fade trader sees this as a prime opportunity to enter a short position, anticipating that the price will get rejected and fall back down. So, we have two opposing strategies, one that follows the trend and one that goes against it. Which one is better? The truth is, neither is inherently superior. The best strategy for you depends on the market conditions, the specific asset you're trading, and, most importantly, your own personality and risk tolerance. Are you someone who feels more comfortable riding a wave of momentum? Or do you have the nerve to stand against the tide? Let's explore how to combine these strategies for a more robust trading plan. You don't have to be just a breakout trader or just a fade trader. The real magic happens when you know when to use each one. In a strongly trending market, breakouts are your go-to. When you see clear upward or downward momentum across the board, trying to fade those moves can be a quick way to lose money. In this environment, you want to identify consolidations and wait for the price to break out in the direction of the dominant trend. On the other hand, in a sideways, range-bound market where the price is just bouncing between predictable levels, fading becomes much more attractive. When the price hits the top of the range resistance, you can look for opportunities to short it. When it hits the bottom of the range support, you can look to buy. In this scenario, trying to trade breakouts will likely lead to frustration, as the price will often fail to start a new trend and simply reverse back into the range. The key is to correctly identify the current market environment. Let's walk through a practical example. Say you're watching a popular tech stock. For weeks, it's been trading between $150 and $160. This is your range. If you're a fade trader, you might sell when it nears $160 and buy when it approaches $150, setting your stop loss just outside the range. Now, one day, news breaks about a new product. The stock price surges to $162 on massive volume. This is no longer a fade opportunity. The context has changed. This is a potential breakout. A breakout trader would see this as a signal to go long, placing a stop loss just below the old resistance level of $160. By understanding both strategies, you can adapt your approach as the market story unfolds. Risk management is absolutely critical for both strategies, but perhaps even more so for fading. When you trade a breakout, you're trading with the momentum on your side. When you fade, you are directly challenging it. Therefore, using a tight stop loss is non-negotiable. If you try to fade a move and it just keeps going against you, you need to have a predefined exit point to cut your losses quickly. Never let a small, manageable loss turn into a catastrophic one by hoping the market will turn around. For breakout trading, the biggest risk is the false breakout. To protect yourself, wait for confirmation. Don't just jump in the second the price crosses a level. Wait for the candle to close above resistance or below support. Even better, wait for a small pullback to the breakout level and see if it holds. If the old resistance level now acts as new support, it's a much stronger signal that the breakout is legitimate. This patient approach can save you from many frustrating fakeouts. Ultimately, mastering breakouts and fades is about understanding market psychology and context. A breakout represents a consensus, a moment when buyers or sellers have definitively won a battle. A fade capitalizes on overenthusiasm or panic, betting on a return to equilibrium. By learning to read the price action, volume, and overall market environment, you can choose the right tool for the job. Practice identifying these patterns on charts without risking real money. See if you can spot potential breakouts and fades as they happen. The more you practice, the more intuitive it will become. You'll start to develop a feel for when a move has real power behind it and when it's just noise. And that, my friends, is how you can use both breakouts and fades to unlock new opportunities and build a more versatile and resilient trading approach. Thank you so much for watching today. I hope this breakdown was helpful. If you got any value from this video, please give it a thumbs up. It really helps the channel. And if you haven't already, make sure to hit that subscribe button and ring the bell so you don't miss our future content. Leave a comment below and let me know which strategy you prefer, or if you have any questions. Until next time, trade smart and stay safe.